I'm Charlotte McLeod with the Investing News Network, and here today with me is Gwen Preston of Resource Maven. Thank you so much for being here online with me today.
Oh, thanks for having me.
Of course, excited to talk, and I think the first thing on the agenda has to be gold. I want to start off by what you think is driving gold right now. I've had a lot of people telling me recently it's all about the increasing debt load. But watching one of your recent talks, you mentioned negative real rates as the main factor you're watching. So I wondered if you could talk a little bit about that and why that's the main thing on your mind.
For sure. So I think the debt load is a big part of the overall picture, but the tangible force that creates, or that sort of comes from that whole setup, is interest rates. And so interest rates determine where it makes sense for, in particular, low risk capital to sit if it wants to make money. And for many decades, all of that low risk capital bought bonds because bonds would always give you 5, 6, 7% annualized returns. That was fantastic. They just owned bonds. Since the great financial crisis and the zero interest rate policy, the birth of the zero interest rate policy, that game doesn't exist anymore. Bonds don't pay. And so all of that low risk capital has to find somewhere else to make its returns. And it has moved largely into the stock market, but there's real risk in the stock market, right? I'm not going to tell you where the stock market is going. It keeps rising. It will likely continue, but in ups and downs, with volatility, we've seen a lot of that in the last few years. So safe money that always bought bonds, can't buy bonds anymore, has to own stocks. It has to hedge the risk that's inherent in its stock portfolio that it has to own. What are its options to hedge that? Well, gold is literally at the top of that list. Negative real rates mean that, so one of the reasons that bonds don't pay, the primary reason, is that interest rates are zero, and so the bonds don't yield. Interest rates don't actually impact gold, but the financial situations that create a negative real interest rate environment usually do support gold. So all the uncertainty, ironically, sometimes it can be a really strong growth environment, or it can be a really stagnant environment, so an inflationary or deflationary environment. But the general setups that support a negative real interest rate environment almost always support gold. We're certainly in that situation right now. And we need that hedging of the stock market because all this low risk capital needs to have bets on both sides just in case. That's the definition of being low risk. So negative real interest rates are always the most important factor for gold. If dollar-based holdings will pay, then money will sit in dollar-based holdings. They'll own bonds and treasuries. But that's not the setup right now. So it needs something else. So that is the real premise of the gold argument. And there's all kinds of things that then add on top of that, but that is really the premise. And what's really important is that we are not only in that environment, but we're going to be there for a while. So the Federal Reserve has made it very clear that they're not raising interest rates anytime soon. Look back to the great financial crisis. It actually took them 7 years to raise interest rates following the great financial crisis. So I don't know if it's going to be 7 years this time, but I think that's a reasonable time frame to look back on. It's going to take a while. Monetary efforts like this just take a while to have impact. And so we're going to be here for a while. If there's any inflation, real interest rates only go more negative and make this argument even stronger. So I really think that's my fundamental argument for gold, and I think it's very stable, and I think it's very strong, and I think it's going to be with us for years from here.
Okay, thank you for that. That was really clear. Um, I think, as you say, there are other factors at play, though. We have the election coming up, we have the debt, we have coronavirus. How do you work through parsing those other factors and putting them into the picture as well?
That's the key question, right? I think there's sort of two sides to that question. So I think that if you are interested in gold and silver, you need to take a look at the overall setup, the kinds of things that I just described, and decide that the environment is bullish for gold. That's your overall premise. Then you want to decide how you're going to take advantage of that. If you want to be active trading on sort of a daily, weekly basis, then you really need to pay attention to a lot of the news flow and the impacts that it's having. And I can talk through all of those. If you don't want to trade on a daily basis, then you don't need to pay attention to all of that. You just need to build a low risk buy and hold portfolio of royalty companies, major operators, gold backed ETFs, optionality plays, things like that. And then the noise doesn't actually matter, because as long as your fundamental premise is correct, then just ignore the noise and enjoy the overall ride up. Now, in terms of the noise, you identified the key things, right? The US election is obviously, it's right around the corner right now. The main reason that the US election matters isn't who wins. It is because the stimulus package that the US economy is desperate for, to help with coronavirus weakness, is in limbo. And it had almost happened when Justice Ginsburg died, and then the bipartisan fight broke out, and that stimulus package evaporated. That's why the stock markets stepped off in September. They'd already priced that package in, and poof, it was gone. It has not happened. Will it now happen between November 4th and January 20th? Another big question mark. It all depends on how the chips fall, right? And so we may be waiting quite some time for this stimulus package. It will happen no matter who wins. And it will be gold supportive no matter who wins, because it's more debt, it's more money printing. It should, if it works, lead to more inflation. And that will all happen in a zero interest rate environment. So it makes real rates more negative. So it'll happen no matter whether there's Trump or Biden in the office. But right now, what matters is that we're all waiting for stimulus, and the markets run on stimulus these days. This is a tail wags the dog deal. This isn't like, yay, there's growth, we should buy stocks. This is, yay, there's not growth, and it's so weak that the government's going to pump money in, and the pumping of money is going to raise stocks, so we should buy stocks. It's absolutely backwards, but it's how it works right now. And so the wait for stimulus is the thing that's holding back both stocks and gold, because it's put a lid on those inflation expectations in the near term. So that's that side. The coronavirus side is very similar. We're seeing rising case counts, of course, rising case counts, and the return of lockdown measures. They're the opposite of stimulus. The market wants stimulus; they don't want lockdown. So that's also having an effect. If you take a step back, what I think is really sort of a theoretical way maybe to approach it is, we're at pretty max pessimism right now, right? Like, no stimulus, the coronavirus is terrible. But stocks do well when there's happiness, and I think that we're headed in that direction. There are vaccines that are making very good progress. The stimulus package will happen, and we have a decade of experience for what stimulus packages do for the stock market. I think that we're heading into a pretty good zone as soon as we get through this uncertain, tumultuous period that we're in right now, where it's kind of almost in limbo while we wait for these things to settle out. And so again, if you want to trade the day-to-day moves, you absolutely can try and track all of these things and trade them. It's difficult, but it's possible. It can create some great returns if you want to. But if you don't want to, then just step back and rest on your fundamental premise for a gold silver market and play the game that's appropriate to that. So you really just have to decide how you want to play, and then what you need to pay attention to.
Right. And tying all of those factors up together, what's your sense of where we're at in the overall gold cycle right now?
Yeah, so it's a good question. We are in unprecedented times in many ways. So it's always, past patterns are always important, but they're never perfect, right? And so if we look at past patterns, timing wise, we are perhaps halfway through a gold market, if we consider it having started at the beginning of 2016, which I think makes sense as phase one. In terms of gains, though, we're less than halfway up for sure. We've only had like a third of the gains that a gold bull market would usually produce. And I think that makes sense. As much as each market is different, they're all also the same in terms of who enters the space when and what that does in terms of momentum. And so I've said it for years, it's the generalists entering the gold space that really drives the market. And that doesn't happen until what I call phase two, which is the second half of a market. And we're seeing that happen. If you just look at the money that's gone into gold-backed ETFs in the last 18 months, it's off the charts. And that's safe money that needs to hedge buying ETFs as its way of hedging stock market volatility. As that trade gets more and more established, it's very well established already, but as it continues, then other money looking for that same hedge, but with a little bit more desire for leverage, will go more and more into miners, and then the money will flow down. And so generalists will increasingly come into the space. The gold space is absolutely tiny relative to the stock or bond market. So, I mean, a 1% allocation to gold across portfolios would blow the market up. Like the gold market couldn't actually handle a 1% allocation. That's why gold markets are so explosive, because when generalist interest rotates over, the market's so small to try and take it all in. And I do think that that's happening. And I think that's what's going to happen over the next few years.
Okay, that's sounding great. I also want to spend some time talking about the juniors. I know you spend a lot of time speaking with companies, so I wanted to get your sense of what's going on with them right now. How are they feeling? Are there any trends you're seeing there? Are there concerns that these companies are dealing with? What is that landscape looking like?
So I think there's a few factors that really matter with juniors. First of all, a lot of juniors were able to raise money when the gold market picked up again following the COVID crisis. And that's fantastic. It sends a lot of teams out into the field. It generates a lot more work, and therefore it generates a lot more discoveries. It makes it seem like discoveries are easy because all of a sudden there's lots of them out there. So first of all, don't think that discoveries have gotten any easier. The odds of success on any one target are still very low. It's just that there's more targets being tested. And so that's exciting and good. So just if you're interested in discovery speculation, remember that you need to own a whole bunch of targets, a whole bunch of companies, because one of them may well work if you have good selection criteria, but don't put it all in one basket, because it's quite likely that that basket will not work. But secondly, all those companies that raised money, May, June, July, August, those are mostly in financings that have 4-month hold on the financing paper. So all of those shares have been coming free to trade sort of August or September, October, November, December. That's when they're coming out. So that's actually playing a very important role in the sector right now. We've seen a lot of stocks that ran up. They raised money, they started exploring, people got excited about what they were doing. And then 4 months later, the lower priced paper comes free to trade and the share price trades down towards that financing level. That's been a really important force in the space. If you're looking at a share price chart and you don't understand based on just the news why the price has come off, look back at the financing timeline and see if maybe there was a lower priced financing that has come free to trade recently. And the scale of the financing, the number of shares that were issued versus the number of shares that the company has out, that's a really significant, that really helps you determine how significant that free trading date will be. So that's one really important force. Another one is just, the interest or junior gold miners, you wish that they would trade just based on the news that's coming out of the ground, right? That's sort of fundamentally, yeah, that's what I want them to do. But that's not what they do. So free trade dates are one example of the kind of pressures that push a junior share price around. But also there's speculation about what a drill is going to hit. There is area play influences. If a neighbor does something exciting, then they might get pushed up. Or if a neighbor reports a disappointing result, they might get pushed down. There's if a company does make a discovery, often the initial reaction is a bit overhyped, and so a share price will really jump, and then it will have to take back some of that ground. So there's a lot of, and then there's seasonality. Lots of companies work in places where they can only explore for some number of months of the year, so that really influences their share price patterns. So it's important for investors who are interested in discovery speculation to be aware that it is about way more than just what the results say. So you really have to be thinking about all the different things that pressure a share price. And to be honest, you have to trade them. We buy stocks because we like the story. So you like it, it's very important to stay engaged with it, but it's also really important not to get too attached. If they make a discovery and the share price spikes, you need to sell into that to some extent to lower your risk. This is a risky business. The follow-up hole from a discovery is almost as risky as the discovery itself, because it will suggest whether there's continuity to that discovery. And so it can plummet the share price on failure as much as the discovery rose the share price, lifted it. So just try to remain level-headed about all the different pressures that push share prices around, and how to take advantage of moves, whether it's buying more when things are down, whether it's using financings to get your position so that you have warrants should the story work, selling into share price spikes, whether that spike is because of a discovery or because of speculation that there's going to be a discovery, paying attention to overall market pressures. We've certainly seen junior share prices slide as a whole over the last 2 months because of these pressures on the gold price. So just try to trade your way to success. It's absolutely essential if you're going to play the junior game that you do some trading. Buy and hold rarely works with juniors. And so that's a lesson that's important because it means you have to stay engaged and you have to, you can't just walk away from your portfolio.
Okay, so obviously it's a really complicated market at the best of times. And right now it sounds like there are so many other factors at play. So I wondered, has your approach to investing changed during this year, this time of coronavirus, election, or are you approaching it as you normally would?
That's an interesting question. I think uh, it's been such a strange year, right? I feel like, when Corona hit, I sold half of my portfolio, and then I had to rebuy it. I can't remember the time frame. A month later, when things stabilized and started to rise up again, that was a move that worked. It wasn't perfect. Some stocks I missed. They were already a bit higher by the time I re-entered, but that's what I needed to do to sleep at night because of all the anxiety and uncertainty in that March crisis. And then there was this very interesting period where, I feel like one day I was like, okay, things are back. We should consider buying Barrick and Newmont. And then like the next day I was like, okay, we're like totally back and I'm going to assess whether I should buy this 10-cent brand new silver explorer, right? It went from low risk to high risk almost overnight because the gold market just took right off. And so that was a good lesson in watching, the majors and how much they gained, not just from the March lows, but even in the gold price move, forgetting about that dip in March. Like they've done really well this year. The GDX, not including the COVID move, is up something like 42% right now. That's a fantastic gain. And so while you can look at a junior explorer and quite often you'll see, some 300% gain on speculation of a result and then disappointment, and it drops off a huge part of that, and then maybe it comes up. Juniors are roller coasters, whereas majors are much more stable. So I think this year has actually been a good reminder of those contrasts. And the lesson to take from that is that there's good reason to have exposure to all of those kinds of gold opportunity because they balance each other out to some extent. So and I'm extra motivated to do that because I write newsletters and I write those newsletters to try to help investors across the spectrum from sort of very low risk and not very low risk investors who don't know a lot about gold all the way through to pretty high risk investors who know lots about the space. I try to give them opportunities across the spectrum. And so that encourages me to look at all of them. And there's been lots of producers out there that have done incredibly well so far this year. So yeah, I think the lesson from the year has just been don't focus in on the thing that you intrinsically love. Like you may love high grade silver veins in Mexico, and there's been some great high grade silver vein discoveries in Mexico lately that if you bought and sold them at the right time or still own them, you've done very well. But there's also been a bunch that haven't worked, and they're all roller coasters because they're juniors. So I think the lesson is play the spectrum, because that's the way to hedge your own exposure within this market.
Well, and on that note, are there any success stories that you would mention from this tumultuous year?
Oh my, yeah, for sure. So let's go through sort of a range of kinds of success stories. So we could go to, if we start back at sort of pre-discovery exploration, I think Outcrop Gold is a good one. So they're exploring in Colombia. A comment there is, this market has gotten strong enough that investors are keen on lots of jurisdictions that they probably wouldn't have invested in 2 years ago. So that's great. But Outcrop is exploring the Santa Ana project in Colombia. They have a very clear, technically sound plan for delineating high-grade shoots in this vein system that has some historic work blah, blah, blah. And they've done really well. They attracted investment from Eric Sprott, who has, sole funded a huge amount of the exploration work in our space this last 2 years. And that attracted eyes, and they keep kicking out good results that continue to delineate these high grade shoots. So I think Outcrop has done very well and still has some good upside ahead. If we go to more advanced stories, I really like Core Mining. So Core has done very well this year. They are a really, they're sort of three companies in one. They have two reasonably advanced projects in California. One is quite advanced, and the Imperial project is quite advanced. Long Valley is one step earlier than that. And then they have this FG project in British Columbia that's high grade gold exploration. And drill results are actually pending from that right now and will be out shortly. So it's sort of through any one of those assets could easily be the cornerstone asset for a junior company. And so they have 3 in 1. And just with the market, its share price has come off in the last little while. So it's done very well this year. I think it offers a pretty interesting entry opportunity right now. And then if you want to play on the big leagues, there's lots of opportunity there. I think K92 has done very well, but I really think that there's a lot of, there's good opportunity for upside left in K92. I mean, I realize it's Papua New Guinea, but if anybody has demonstrated that Papua New Guinea is functional, it's K92. They have incredible exploration potential around their mine, which is tapping into very high grade gold. Their costs are low. It's just really doing well. And the exploration opportunity there is sort of the, oh my goodness, what might this become side of the story. And then you can get even bigger. I mean, you can look at SSR Mining or Equinox Gold. So I like looking at stocks where there's very good fiscal management. So the balance sheets are strong. They're making good decisions about debt. Most gold companies fit that bill now. They certainly didn't a decade ago, but a lot of them do now. And I like ones with strong growth profiles. And Equinox Gold in particular probably has the strongest production growth profile across the mid-tier operators in our gold space.
Okay, that's great. I love that there are a lot of options across the spectrum. As we're finishing up, I wondered if there are any other metals aside from gold that you're interested in right now.
Good question for sure. So I think I'll mention platinum group elements. I think palladium in particular is doing well, and that is likely to continue. The palladium deficit remains. It got a little bit people got a little confused about what was going to happen there with all the shutdowns and demand cuts during COVID, but really it has come out in the wash, and palladium demand remains strong, and we're still in a deficit there. So I think that I don't know if there's a huge amount of upside left in the price of the metal, but I think stocks could continue to do well because there's a real dearth of projects there to fill that supply gap. And then copper is just a standout here. I mean, I don't know if copper is going to do particularly well in the next 2 months. I think a lot of that will depend on when the stimulus package happens and what it includes and whether China announces new stimulus and things like that. But there's been quite a price run in the last 6 months. And so I think I wouldn't necessarily say right now you need to buy copper, because I think the likelihood of a near-term setback is reasonable. But if you go out a year or two, I mean, the numbers just don't lie. We end up with a supply gap. There aren't projects to fill the gap. The current pricing does not incentivize the kind of mine builds and production increases that are needed. The copper numbers don't lie. I'm very bullish on copper, just not in this exact moment, but pretty soon.
Okay, well, that's great. Any final words for investors as we head toward the end of the year?
Good timing question. What am I doing right now? So I think there's 2 things to think about right now for your portfolio. One of them is tax loss sales. So it's been a volatile year. Hopefully gold, silver investors have locked in some nice gains in their portfolio with the opportunities that were afforded to us. That means that you'll have capital gains that you'll have to pay tax on. So if there are stocks that you entered when things were high before they slid off, we all did that. I did that. I just did some selling literally yesterday because I'd bought some stocks thinking that the dip was going to be moderate, was going to be quick. I bought, and then guess what? The dip has continued and I'm down on those positions. And I was like, you know what? I'm going to lock in those losses. it's more than 60 days till the end of the, or more than 30 days till the end of the year. In order for tax losses to be applicable, they can't look superficial, which means you can't buy the stock again within 30 days. But I got way more than 30 days till the end of the year. So I sold some positions that I had bought too optimistically in August, and I'm going to be able to apply those losses against gains from other sales that did well. And then the stocks that I like, which all of them I do because I literally only bought them 6 weeks ago, I can buy them again before the end of the year. And likely, assuming stimulus doesn't happen until after the inauguration, blah, 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 and just basic seasonality for gold, it's quite likely that a lot of stocks will be at current prices, a bit lower. They're not going to do anything dramatic between now and the end of the year. So I can rebuy those positions and then have exposure to them after having taken advantage of the tax loss. So tax loss is absolutely one thing to be thinking about right now. And then just adding to positions over the next little while. There may well be a bunch of volatility. So that makes it tough to sort of choose your day maybe. But if there's stocks that you particularly like, well, things are obviously less expensive now than they were 2 months ago. And given my outlook for what will happen in Q1, I think they're less expensive now than they will be in 3 or 4 months. And so this sort of time frame, I think, is a good time frame to be adding to stocks that you like. Buy in tranches. It's very difficult to understand what gold or silver is going to do on an hour to hour or day to day basis. But if you put in some stink bids and buy in tranches, then you reduce the pressure on yourself of trying to pick the perfect entry point. And you can just accumulate positions at right now, which is, I think, a generally good level at which to be buying stocks that you like. Of course, be aware of news flow. If they are about to put out results from their drill program, be aware of those kinds of pressures, or free trade dates, all of these things that push stock prices around. You have to be aware of those. But yes, accumulating favorites over the next month, I think also makes a lot of sense.
Okay, well, thank you so much. I think that was a lot of great actionable advice for investors who are willing to do their research.
Thank you so much for having me. I always appreciate the opportunity.
Thank you. And once again, I'm Charlotte McLeod with the Investing News Network, and this is Gwen Preston with Resource Maven.